Ho, ho, ho! Welcome back to the Fit Finance sessions. What are we doing? Advent calendar. It's the window opening. And today we're going to go up the risk charts a little bit. We're going to have a look at something called a venture capital trust, a VCT. I've heard these are a bit harem scarer, Tom. Can you set me right?
Venture capital trusts are definitely higher risk than, say, a standard portfolio that we would set up. And you might have heard of venture capital before, and that's effectively what you're doing there is investing in earlier stage companies. And by doing so, you get some nice tax breaks. So if you've made use of your ISA and pension allowances that we've been talking about before, perhaps considering venture capital trusts are maybe a next stage for you. And the premise is, from a tax position, that you get 30% income tax relief on your investment, and the returns come via dividends, but the dividends are also tax-free. So you might not get a lot of capital value change, but you might get some really nice dividend returns in a tax-free way. And the way they generally invest is a management team will then they'll raise money within the VCT, the venture capital trust, and then they'll allocate that to various small companies. And if one does particularly well, they'll give it some more cash, and then they look for an exit or a sale opportunity. And that's generally where the returns come from. But because you're investing in these smaller companies, a lot of them could fail, and it might be that 18 of them fail, but one sells to Facebook for 200 million. So, and that's kind of the logic. So there are more risks, but you get some nice tax reliefs, and as part of an overall plan can be a useful tool.
Cool, Tim. I bet you've got a whole list of things that you're gonna line up now for the risks of owning a VCT. Go on.
Well, I think Tom's really hit it on the head, and I mean, I don't know how many times we've already said risk on this particular episode, but yeah, I mean, anybody putting money into these things, you just need to understand you're investing in much smaller companies, and there's just clearly inherent risks in doing so. So you've got to be very wise to that. The other thing, with regards to the tax reliefs that you get from paying into, that there is a holding period in which you need to hold on to the shares to be able to maintain those tax reliefs. So the tax relief is given to you up front. excuse me. But if you sell the shares in the trust for the first 5 years, or within 5 years, I should say, then you get that claim back off you. So, if you think, this is a great idea, I will hold it through, but after year 2, things start to get a little bit shaky, and you'd really rather not. You're just going to hold on tight, I'm afraid, if you want to keep hold of that tax relief.
Okay, so they're not that bad then. They sound like a nice bit of tax relief, but you've got to accept the fact that you're going to be invested in smaller companies, portfolio smaller companies for about 5 years, and hopefully you're all right at the end of that, and there's a nice big kicker, and one of those small companies happened to be Amazon. But we'll see. Anyway, brilliant. Thanks very much, chaps. And until next time, see you later. Bye-bye.